Welcome to Chapter 8, where we'll talk about capital gains and losses. Taxes on capital gains did not come into place until 1972, and then shortly thereafter they implemented a lifetime capital gains deduction in 1985. One of the other varying factors is that for these different time periods, so only a portion of the capital gains or losses were included for taxable consideration. About half of the capital gains for the first number of years went up to 2/3 and 3/4, and then dropped back down in the last 20 years approximately to half of the capital gains. Capital gains are typically occurring when a taxpayer disposes of a capital asset, and we described various capital assets in Chapter 6, of those being items that earn income in the form of business profits, interest, dividends, royalties, or rents, etc. Also, under Income Tax Section 39(4), there's an election for Canadian securities where they are allowed to be treated as capital property. It is important to understand that disposition of capital assets can happen through many different ways. It can be sale, through the redemptions of debt securities, cancellations of such, expirations of options, transfers to trust, expropriations by government or other purposes, gifts to others, or other various deemed dispositions such as the death of a taxpayer. To determine the proceeds of disposition, it could be sale or redemption proceeds, it could be insurance proceeds where you would indicate the amount that received for insurance for that said property. It could be expropriation proceeds, the amount received from the government or body that's expropriating the property, or other various deemed proceeds such as fair market value. It's important to remember what the adjusted cost base is for your calculation of capital gain or loss. For depreciable assets, it's always the capital cost, which follows the accounting concepts. But for non-depreciable assets, it's cost, but there are some potential adjustments under Income Tax Section 53. A few of those items are listed on page 347, where it talks about government grants that you might have received, some superficial losses that may have occurred when a taxpayer disposed of a property, any stock option benefits, or other adjustments to the cost base that may have occurred during the lifetime of ownership. Specifically talking about government grants, they are always deducted from the cost of the UCC. It's the same procedure as under GAAP. For superficial losses, you look at the transaction date for the capital loss incurred, and if you held that position 30 days before or 30 days after the date of loss, you cannot include it because it's considered a superficial loss. An example of this is where you have securities with an adjusted cost base of $15,000. You sold them for $10,000, but then you bought them shortly thereafter for $8,000. So your proceeds of disposition were $10,000, your cost was $15,000, so you had a disallowed loss amount of $5,000. Under Income Tax Act Section 53, your new adjusted cost base would be the $8,000 paid for the new securities, or the replacement securities, plus the $5,000 disallowed loss. Your actually adjusted cost base for those positions are now $13,000. When there's a stock option benefit, the adjusted cost base will include any employment benefit that's included income at the time of the stock option was exercised. And it's important to note that if your adjusted cost base becomes negative, you have to actually get that back to zero, and it becomes a capital gain because you have to have the adjusted cost base to a minimum of 0. And just recall, for tax considerations, if they are refundable or rebatable, whether a part or in whole, any of those refundable amounts are reduced from the original cost, therefore they're not included in the adjusted cost base. One of the general rules, a little example, is say you have an asset that you sold for $100,000 and your adjusted cost base was $55,000, but it cost you $6,000 to sell that item. You have a total cost of $61,000. Your capital gain would be the 100, take away the 61, otherwise known as $39,000. The inclusion rate is half at this time, so half of that would be considered your taxable capital gain, being $19,500. An example here, we have individual purchases where this person bought 100 shares 1 point, 150 another point, 75 another point at three different prices. A little table at the bottom that walks through the various purchases. At the end of the time, they would have 325 shares in total at an average price of $12.69 each, being the cumulative amount of their spend being $4,125. If they sold 100 shares at $20 a share, their sale proceeds would be $2,000. Their adjusted cost base would be the $4,125 spent over the 325 is $12.69 each times the 100 shares sold. Their ACB for this sale will be $1,269, showing a capital gain of $731. And when there's a partial disposition, typically the adjusted cost base is allocated on a reasonable basis, which in many examples when you're talking about land is based on actual acreage. However, if there's some other way to justify value in a different manner, as long as it's documented and detailed and considered reasonable, it would be acceptable. When talking about warranties, if you give a warranty after you sell the property, that warranty becomes a capital loss if and when you incur costs in a future period. So on the sale of the capital asset, the full payment is included to consider your capital gain at that point of sale. In some situations, you may get a capital gain from a sale of a transaction, but where you're getting cash payments from the buyer in future periods. So there is an ability to create a capital gains reserve. However, under Income Tax Section 40, there is a limitation where they cannot defer it for more than 4 years because it was coming up as a way that people were trying to avoid and defer tax much longer than ever expected or anticipated. That was considered unreasonable. So we have an example here where we have an asset with an adjusted cost base of $350, sold for $550,000, and only $150,000 was received in cash in the year, with the balance coming next year. You have a gain of $200,000. The maximum reserve would be the lesser of the gain, being $200,000, times the proportion paid. So the organization paid $400,000 against the $550 selling price, so that is $145,455. Or $200,000 gain times 20% times the fact that 4 minus 0, so 4 years maximum minus 0 years past, would give you $160,000. So in this case, you would have a maximum reserve of $145,455. To continue this example the following year, the reserve from the previous year that we set up being $145,455 would all be added back to income, and we would deduct nothing further in that following year because the buyer paid the full balance in that second year. If on a sale and an acquisition by another party you have a bad debt related to the transaction, if in the future they don't pay it off or a portion of it, any amount that's related to the sale of the capital asset would be included in the capital gain, and any write-off required for that AR exceeding the original capital gain would be considered a capital loss and subject to carry forward opportunities. A little example on that is on the top of page 354, where an organization sold a piece of property for $510 with a cost of $500,000, with the taxable capital gain being $5,000, being half of the $10,000 gain. However, during the following year, 2020, the purchaser didn't pay the balance of the note. So the deemed disposition or reacquisition would result in an allowable capital loss of $75,000. 5 of that would offset the $5,000 original taxable capital gain, with the balance of $70,000 carried forward. Alright, when it comes to sale of real property, there was a problem where any terminal loss on a building is 100% deductible, but any capital gain on land is only 1/2 tax. So it created a situation where organizations would have incentive for manipulating the allocation between land and building. So the government came up with a solution where it limits the proceeds of disposition for the building in a way that it reduces any terminal loss by the amount of the capital gain on the land. There's a good example on page 355 where it talks about the deemed proceeds of disposition for the building to be determined as the lesser of the following two rules. And those rules would be the fair market value of land and building, reduced by the lesser of the adjusted cost base of the land or the fair market value of that said land, or the greater of the fair market value of the building and the lesser of the cost or the UCC of the building. Again, lots of details on a little schedule on page 355. An example here, following or continuing on page 355, is where real property sold for $410,000 with the land having an adjusted cost base of $200 and a fair market value of $300. Building the original cost was $175 with a UCC of $150 and a fair market value of $110. A normal result would be a $50,000 taxable capital gain on land, along with a terminal loss on the building of $40. A net inclusion in taxable income of $10,000, and this would encourage allocating more of your proceeds to the land. Under income tax action section 13, it would limit the terminal loss by requiring additional proceeds to be allocated to the building in order to eliminate the loss. So again, if you follow the details on page 355, the ending result is that the taxable income will be $20,000 higher. So special assets, specifically principal residences, there's a form called T2091 where it determines which property you designate as your principal residence. If you only own one property, it's not required. However, if you own more than one, you'll definitely want to complete it because any principal residence upon sale is not subject to capital gain tax, but you're only allowed to have one at any given time. There's a specific formula when it comes to principal residences where there's a gain reduction formula that looks at the total capital gain and compares it against the years designated as your principal property divided by the number of years owned. Little example here for walking you through a person that owned one house for 3 years and another house for 3 years, and the capital gain on each principal residence, where in section A or residence A they had a $20,000 gain, but it's reduced by 3 out of 3 years. And B, it's the $30,000 gain, but it's reduced to 3 plus 1 divided by 4 years. It's just demonstrating how you need the plus 1 in the formula in order to eliminate the gain on the second sale, because you can't have two homes designated for the same period. So you always have a little overlap between residences. Principal residences can only have one per family unit, and they can only have to be up to half a hectare of land without demonstration of why the additional land was needed. So half a hectare is about 1.25 acres. There is some special assets where personal use of property is primarily enjoyed by the use of taxpayer. How is the tax? Typically gains are taxed, but there's a special algorithm where it looks at the minimum proceeds of disposition and a minimum adjusted cost base, both being at $1,000, where gains are taxed and losses are not. Just a little more detail on pages 358, 359 of the text if you want to follow along in more depth. For specific listed personal property, the examples include specific works of art or some rare books or coin collection, etc. It is taxed, but in this situation gains are taxed, but losses can be claimed, but only against other listed personal property gains. If you don't have any gains in that said period, you are able to carry it over. So gains and losses on foreign currency is that under GAAP, at each balance sheet date, you need to ensure that you update the value of any of those foreign currencies on your balance sheet, record the gains and losses as you measure and accumulate them. An example specifically is, say, a Canadian company bought some merchandise in pounds at $100,000, euros, and at the time the euro is worth $1.40 Canadian. When they closed the books on December 31st, the foreign exchange rate dropped to $1.30 and the payable was not yet paid. So the company would have a taxable exchange gain of $10,000. Differently than income transactions as previously discussed is capital, so where an organization borrows funds, foreign currency funds, to pay for a capital transaction. Any gain and loss for tax purposes is only when the debt is repaid. And this differs drastically from GAAP, resulting in a timing difference between accounting for net income due to accounting policies versus tax income. So if we follow through a similar example where they purchased a capital asset on credit for 100,000 euros, exchange rate was 140, it drops to $1.30 at December 31st, but they have yet to pay the debt, no gain would be recorded until the debt is paid. Now the situations where you buy or sell capital assets, And the gain or loss is when the foreign funds are converted. So whenever you do the conversion between Canadian dollars and the foreign currency, you would record the gain or loss at that time of purchase. And examples where they use foreign currency to buy some securities. They bought 500,000 euros worth of securities at $1.60 each, and he uses that to buy them when they are worth $1.55. So he paid $1.60 to get the 500,000, but they bought the securities when it dropped to $1.55. So at the time of purchase, there's an exchange loss of $25,000 being the 5 cent per dollar gap. At the time of the sale of the assets, where he sold the securities later on when the euro was down to $1.50, there would be an additional capital loss of $25,000 because the currency dropped an additional nickel. So when we're talking about capital gains or losses on options, is when it's sold, the issuer proceeds to treat it as a capital gain at the point of sale. If the option is exercised, the issuer, the price becomes part of the proceeds of disposition, and they can refile their original tax year to remove the original gain that they recorded. To the purchaser, it's added to their adjusted cost base. If it expires, the issuer no further tax consequences. They already reported the capital gain at the point of sale, and the purchaser would then record a capital loss at that time. An important concept to introduce is our deemed disposition, where it requires an item to be given a different tax treatment that's inconsistent with the actual change or legal form of the item. Examples include changes of use between business and personal perhaps, or departure from Canada where you're no longer a resident, and specifically around death of an individual, which has additional coverage in Chapter 9. And one example around the change in use, business to personal, the deemed disposition or the reacquisition is based on fair market value. If it's going from personal to business, it's based on fair market value. But if the fair market value exceeds the cost, the undepreciated capital cost is limited to the old cost plus 1/2 of the excess of the proceeds of disposition over the cost. An example where we go from business to a personal asset, where a sailboat with an original cost of 200, a UCC of 125, and a fair market value of 250, and it goes from business to personal, there'd be a taxable capital gain being 1/2 of the difference between the fair market value and the original cost, so 1/2 of the 50. And there'd be a recapture of $75,000 because the business took a $75,000 write-off, being the difference between the original cost and the UCC on the books. Where a similar situation where it goes personal to business, though, the capital gain would be $50,000, personal capital gain. The new UCC would be the 225, which is the $200,000 original cost plus 1/2 of the capital gain. And the capital cost to the business would be $250,000. One example of the change in use in principal residences, where a principal residence becomes a rental property, there's a section under Income Tax Section 45.2 that allows you to elect to have no change in use on the personal to business. What this does is it allows the residence to remain a personal residence for 4 years, and it can be more if the employer required the move. It defers any taxation until the time of sale for any capital gain potentially on the residence itself. And the biggest exception is that you're not allowed to claim CCA on that property while under this election. One of the situations where you have a rental property that becomes your principal residence later, there's a section ITA 45.3 where you, in one example, might have bought the property, you rent it out, and it later becomes your principal residence. You can treat it as your principal residence for up to 4 years prior to the date of move, with no change in use with that said move. The biggest exception is that you can't have taken CCA on that property. Specifically for automobiles, we did discuss it in Chapter 5, but it allows you to calculate a 100% figure for the year for what's deductible for automobiles, and then you apply the percentage for the year for the split of business versus employment. Another area of deemed disposition talks about when you depart from Canada or you emigrate. In general, all your capital property will be deemed disposed at that date of departing from Canada. Some exceptions are around some real property owned or business property, and excludes other interests such as your RSP balances. One of the deferral provisions around small business investments is that they must be an eligible small business corporation, or the investee must be such. And the assets can have a carrying value in excess of $50 million. The qualifying disposition, it could be either the sale of that said corporation, and it must have been held for at least 185 days.
In addition to that, there must be a replacement shares where they are acquired within 120 days after the end of the year in which the qualifying disposition took place. They must be designated as such. You are allowed to defer only a fraction of the capital gain resulting in the qualified disposition, and the fraction is based on the ratio of the lesser of the cost of the replacement shares and the proceeds of disposition divided by the proceeds of disposition, and it cannot exceed 1. The adjusted cost-based reduction is where they have to be reduced by the amount of any capital gains deferral. There's an example on page 371 if you'd like to walk through some details. An example here is in October 2019, John disposed of shares in an eligible small business investment for $850,000. The adjusted cost base for those shares was $450,000. In January 2020, he acquired shares in a new eligible small business investment at a cost of $600,000. His eligible gain would be the $850,000, take away the $450,000 original cost, being $400,000. His deferral would be pro rata portion of the $600,000 reinvested divided by the $850,000 proceeds times the $400,000 gain, giving a result of $282,353. And the adjusted cost base of the new investment would be the $600,000 paid less the deferred component being $282,353 for a total of $317,647. And next we'll talk a little bit about involuntary dispositions for property. Here's an example where we have involuntary disposition with a capital cost of a building of $700,000, UCC of $250,000 destroyed in a fire. Insurance proceeds are equal to fair market value being $2 million, and yet it costs us $2.5 million to build later on. In this situation, we've done no election to defer the taxes, so there'll be a capital gain of $1.3 million, being the $2 million less the original capital cost. There'll be a recapture of $450,000, being the $700,000 capital cost less the UCC on the books, and then the capital cost and UCC of the new building will be $2.5 million. Same situation, but where there's an election and they'll amend their return. The 2019 capital gain and recapture are eliminated in this situation. However, the new capital cost will be the $2.5 million invested plus the $1.3 million gain not claimed, which is the $2 million take away the $700,000 capital cost for $1.2 million. Their UCC, however, would be $1.2 million less the $450,000 capital gain recapture that's not taken. So the UCC will be an amount of $750,000. For deferral provisions on replacement property for an involuntary disposition, when you make the election, you can allocate the proceeds of disposition between the land and buildings in any way you wish. Similarly, for the replacement building or property must occur within 24 months after the year in which the disposition took place. Typically, the disposition can be dated on the date of the insurance check received, which could occur in a different year than the original event occurred. And involuntary dispositions can be applicable to most types of business property. For voluntary disposition, it's applicable to former business property only, and it has to be replaced by the end of the first year after disposition. For capital gains and tax planning, the advantages are that you can control timing of the gains when you recognize, and you can use timing to utilize losses. That's all in this slide deck for Chapter 8.